You opened a Roth IRA. You funded it. You did the responsible thing, and you are still making a mistake that could cost you $300,000 by the time you retire. That is not hyperbole. It is a compound interest calculation. And I am going to show you exactly where that number comes from. Today we are covering the 7 most common Roth IRA mistakes, from the one almost nobody talks about to the one that affects literally millions of Americans right now. Some of these you can fix in 5 minutes. All of them are worth understanding. This is the mistake that generates the $300,000 figure, and it is the most common Roth IRA mistake in existence. When you open a Roth IRA and transfer money in, that money does not automatically invest in anything. It sits as cash uninvested until you tell it where to go. Fidelity, Schwab, Vanguard, and every other major broker works this way. The account is a container. You have to choose what goes inside it. Millions of people open a Roth IRA, fund it, sometimes for years, and assume it is invested. It is not. It is sitting in a cash position earning 2% to 4.5% if they are lucky, or near zero if the broker defaults to a settlement fund that earns almost nothing. Here is the math. You fund your Roth IRA with $6,500, the 2026 contribution limit, at age 30. You leave it in cash at 2% until you retire at 65. That $6,500 grows to about $13,000. Fine. Alternatively, you invest that $6,500 in a total market index fund returning 10% annually. At 65, it is worth $187,000. Tax-free. On just 1 year of contributions, the difference between cash and invested is $174,000. Now scale that over a lifetime of annual contributions, and the gap easily exceeds $300,000 in lost retirement value, all from money that was in the right account type but in the wrong position inside it. Right now, after this video, log into your Roth IRA. Look for a line that says cash or settlement fund. If anything is sitting there uninvested, fix it today. Assuming you are actually invested, the next mistake is being in the wrong funds. The most common wrong choice: actively managed mutual funds with expense ratios above 0.5%. The average actively managed fund charges 0.66% per year in fees. Some charge 1% or more. Vanguard Total Stock Market Index Fund charges 0.03%. Fidelity Zero Total Market Index Fund charges 0%. Those are not typos. Fidelity's zero-fee funds exist and are available in your IRA. What is the difference between 1% and 0.03% in fees? On a $100,000 Roth IRA balance, the 1% fee costs you $1,000 per year. Over 30 years, assuming 10% gross returns, the fund with 1% fees delivers a final balance of approximately $1,745,000. The same fund at 0.03% delivers $2 million. The fee difference, just from that one decision, costs you roughly $255,000 over 30 years. For most people, the right choice inside a Roth IRA is brutally simple. 1 or 2 broad index funds. A total U.S. market fund. A total international market fund if you want global exposure. Done. No picking stocks. No sector bets. No target date funds with embedded fees. Simple, diversified, low cost. The 2026 Roth IRA contribution limit is $7,000 per year if you are under 50. If you are 50 or older, the catch-up limit brings it to $8,000. Most people do not max out. According to Vanguard's How America Saves report, only 14% of IRA participants contribute the maximum. That means 86% of people are leaving money on the table, specifically, the most valuable money there is, tax-free growth. Every dollar inside a Roth IRA grows completely free of federal tax. Dividends, not taxed. Capital gains, not taxed. Withdrawals in retirement, not taxed. You pay tax on the contribution going in, then never again. That tax advantage is worth more the higher your balance grows. If you can only contribute $100 per month, that is $1,200 per year. Still far better than zero. Increase it when your income allows. The goal is to eventually reach the full $7,000. One important note: income limits apply to Roth IRA contributions directly. For 2026, the phase-out begins at $146,000 modified adjusted gross income for single filers and $230,000 for married filing jointly. Above those thresholds, your ability to contribute directly phases out. That brings us to the next mistake. If your income exceeds the direct contribution limits, most high earners simply assume they cannot use a Roth IRA. This is incorrect, and it is an expensive assumption. The Backdoor Roth IRA is a legal strategy that has existed since 2010. Here is how it works. You make a non-deductible contribution to a traditional IRA. There is no income limit on this contribution. Then you convert the traditional IRA balance to a Roth IRA. The conversion triggers ordinary income tax only on the converted amount, but since you made a non-deductible contribution, you already paid tax on that money. If done cleanly, the tax impact is minimal. The important complexity: if you have other traditional IRA money with pre-tax contributions, the pro rata rule applies and complicates the calculation. You need to consult a tax professional or at minimum understand the pro rata rule before executing a backdoor Roth. For people with no other traditional IRA assets, it is straightforward. The Mega Backdoor Roth is a related strategy available to some 401k plan participants, contributing after-tax money to a 401k and then rolling it into a Roth. Contribution limits here can reach $46,000 or more annually in after-tax 401k space, depending on your plan. Not all 401k plans allow this. The Roth IRA has flexibility that traditional IRAs and 401k's do not. Your contributions, not earnings, just contributions, can be withdrawn at any time, for any reason, tax-free and penalty-free. You already paid tax on them going in. The mistake is misunderstanding this flexibility and touching the earnings early. If you withdraw Roth IRA earnings before age 59 and a half and before the account has been open for at least 5 years, you pay ordinary income tax on those earnings plus a 10% early withdrawal penalty. There are exceptions for first home purchase, disability, and a few other qualifying events, but the general rule is, earnings stay in until 59 and a half. The problem is that when the market drops and anxiety spikes, people log in and pull money out without understanding the distinction between contributions and earnings. They end up paying taxes and penalties on amounts they did not need to touch. Rule of thumb: your Roth IRA is not an emergency fund. It is not a savings account. It is a 30-year investment vehicle. If you need flexibility, build your emergency fund separately, as we covered in the last video. This one takes 60 seconds to fix and most people have never done it. If you die without a named beneficiary on your Roth IRA, the account goes through probate. Probate is a court-supervised legal process that is slow, expensive, and public. Your heirs may lose a significant portion of the account to legal fees and delays. In some cases, the account is distributed according to your state's intestacy laws, not your wishes. A named beneficiary bypasses probate entirely. The account transfers directly to your chosen person with minimal friction. Log into your brokerage. Find Beneficiary Designation in Account Settings. Add a primary beneficiary. Add a contingent beneficiary, a backup in case the primary pre-decreases you. Done. 60 seconds. It could protect hundreds of thousands of dollars in transfers for your family. This is the most expensive mistake of all, and it is entirely about inertia. The number one reason most people do not have a Roth IRA is not income. It is not complexity. It is that they have not done the 15 minutes of setup required to open the account. Fidelity lets you open a Roth IRA online in about 10 minutes. Schwab and Vanguard, similar. You need a social security number, a bank account for funding, and basic personal information. No minimum balance required at Fidelity or Schwab. The barrier is psychological, not logistical. The cost of waiting 1 year, if you were 30 and would have contributed $7,000 this year but did not, that $7,000 grows at 10% for 35 years into approximately $197,000. Tax-free. You left $197,000 on the table by not opening an account in your 30s. 5 years of delay on that same $7,000 costs you about $120,000 in final value. Let me close with the full picture of what a properly used Roth IRA does over a career. Age 25 to 60. Contributing $7,000 per year, that is $583 per month. Invested in a low-cost total market index fund at 10% average annual return. Total contributions over 35 years, $245,000. Final balance at 60, approximately $1,900,000. Federal income tax owed on withdrawal, 0. That same money in a taxable brokerage account would have grown similarly, but withdrawals in retirement at 15% to 20% capital gains tax would cost you between $250,000 and $330,000 in taxes, money the Roth account never loses. The Roth IRA is one of the most powerful legal tax shelters available to ordinary Americans. The government gives you this. It is not a loophole. It is not a secret. It is just widely underused because it requires a decision most people delay. Open the account. Fund it. Invest it in low-cost index funds. Name a beneficiary. Do not touch the earnings. Increase contributions whenever you can. That is it. The system is simple. The execution is available. The cost of not doing it is $300,000 and counting. Word count, 1/315 duration, 10-minute end card. Next video, the life insurance lie that's made the industry $180 billion.